Good evening and hope everyone is safe and doing well. I, Shubhashika from Native, and my co-host Yatri from Executive Access welcome you to our sixth webinar, Live to Lend Another Day. Our power-packed panel today will deliberate the present and the future of corporate credit. Credit institutions are under stress globally, and the India story is no different. Institutions are rethinking their operating strategies, their risk strategies, and while things definitely seem uncertain and unpredictable in the world of lending today, and many would like to believe it is your risk appetite that defines you, let's find out what do the stalwarts of the industry believe is the right thing to do. Is the risk worth taking, or do we live to lend another day? We are glad to introduce our eminent panel. Our first panelist is Ajay Mahajan. Ajay is known for building businesses within financial services sector. He has a career of many firsts with setting up of banks like IDFC First, Yes, and UBS, including his two entrepreneurial ventures. He has recently joined Care Ratings as MD and CEO. Welcome, Ajay. Our next panelist is Jaspal, Bindra, chairman of one of the leading financial services giants in India, the Centrum Group. Jaspal is a seasoned banker with a successful career of over 30 years globally. He was previously the group executive and CEO Asia for Standard Chartered and has also worked with Bank of America and UBS. Our next panelist is Manish Kothari. With an illustrious career of over 25 years, Manish has been instrumental in setting up and growing many business divisions of Kotak Mahindra Bank into success stories across corporate finance, emerging, MNC, and large corporate businesses. He is currently the president and business head for corporate banking at Kotak Mahindra Bank. Thanks, Manish, for stepping in, given Manian had an exigency and couldn't be with us today. Our next panelist is Rakesh Singh. Rakesh is the MD and CEO of Aditya Birla Finance and has also serves as director on the board of Aditya Birla Housing Finance and Aditya Birla Money Mart. Prior to joining ABFL, Rakesh spent 16 years with Standard Chartered. He has over 25 years of experience in financial services industry across banking and non-banking. Our last panelist is Rohit, a veteran banker who has worked with some of the marquee leaders in the country and is now the MD and chairman of a leading ratings firm, India Ratings and Research. Prior to IRR, Rohit has been associated with RBS in various roles, most recently as MD and head of Global Transaction Services, APAC. He has also worked with ABN AMRO and ANZ Grinleys in the past. Welcome, Rohit. And last but not the least is our moderator, Ananth Venkat. After a very successful career in banking, leading the corporate and investment banking businesses for banks like Standard Chartered, Credit Suisse, Deutsche, and Bank of America, Ananth has been startups in mentoring early stage companies as board member or independent director. He is now an independent director with IHCL, Access AMC, Ecom Express, and a board member to Critical Eye. Welcome, Ananth. Over to Yatri for a quick to-dos for today's session.
Thank you for the introduction, Subhashika, and a warm welcome to our panelists and moderators. Just two instructions before we start. For those who've logged in from mobile devices, please swipe right or left to see the entire panel. Second, there is a Q&A button at the bottom of your screen. Please feel free to start sharing your questions. We will be taking them towards the second half of the session.
I think most of the sectors have been impacted. Discoms is one, and little bit of, I think the support has come, but the travel, aviation, I think the entire hospitality, there's so many sectors which has got impacted so hugely, and we don't know when will they come back, because I don't know when we will be able to travel freely internationally or domestically. So there are so many sectors which has got impacted, and a lot needs to be done, much beyond what we have done so far. So I would say stimulus, reforms, and resolution of a few of the stressed sectors.
So more to be done and more across the board. Okay. Yeah. Manish, over to you, your views on this.
So kind of agree with what Jaspal and Rakesh have shared. See, in my view, this is not something which everything can be thought through upfront. I think this will be a journey. So the structural reforms which the government has come up with, whether it is on the agri side or coal, minerals, defense to some extent, they have tried to address the bottom of the pyramid by the Rega scheme, or in terms of providing some sort of cash flow to the people at the bottom of the pyramid. Liquidity measures at the bank level as well as at the corporate level. Obviously, some measures have been taken with respect to ensuring that there is appropriate liquidity at the bank level, and also some bit of liquidity measures also for the corporates, as well as in terms of providing moratorium on term loans, so cash credit and working capital easement. I guess like Rakesh was also mentioning, the impact is so huge and across sectors, it is anybody's guess exactly how the revival is expected. Only finally will not help. Solvency will come only through finally demand coming through, right? Finally, solvency for businesses or viability for businesses are entirely dependent not only on liquidity and cash flows. It will also then end up looking at how exactly are they becoming solvent, which is by way of finally demand coming back. Now, that is anybody's guess in terms of how quickly it will happen. And my sense is that more measures which are relevant at a particular point in time will need to be brought in specifically for sectors which are impacted far more than maybe the rest. And government is possibly in the best place to take some of the risks, because like I mentioned right at the beginning, it is a very difficult cycle to bridge when it comes to taking risks by the private sector enterprises. And I know government has its limitations with respect to fiscal deficit in terms of how much they can really put out. But I'm sure that what they have announced just now, there is possibly still some more room.
Thanks, Manish. All three of you alluded to sectors in terms of, which some sectors there's hope, there's new. Just while you spoke about reforms, Rakesh and Manish, you spoke about some sectors being affected more than others. Let me now move to Rohit and Ajay and ask Rohit to start with. Which sectors, based on what corporate India is telling you, have been affected the most, and which ones do you think will bounce back the fastest?
Okay, I think in short, most sectors today are in the shorter run experiencing the impact of COVID. There'll be few which will weather the storm at this point in time, but most are, and everyone is looking at short-term measures on cost optimization, whether it be reducing the real estate footprint, commercial real estate footprint, or looking at their headcounts and sustaining or managing the liquidity in such a way that they conserve it. Could mean they're delaying data payments, or they are at the upper end of the rating curve, and so have been able to raise money more effectively using all the windows that were available and continue to conserve liquidity. It's also reflected in the fact that when you look at moratoriums, the moratoriums on the corporate sectors are far fewer. They're asked for moratoriums than they are in the MSME or the retail space. But as you look forward, I think we clearly need to look through financial year 21 into financial year 22. The decisions on sectors or otherwise, and therefore I think all of us are developing our own unique frameworks. But at India Rating, I think we've developed a framework which is bucketing sectors and forecasting their recovery paths and using this over a 2-year period. And we're grouping them on the basis of speed of recovery of demand, their supply side readiness, whether they have interlinkages with other sectors, and clearly availability or access to liquidity. That recovery path over a 2-year period, I'm just setting the context to come to the specific sectors just so that people understand the work that's going on behind it. Then that recovery path is actually plotted against and moderated at what we call the COVID multiple. Is actually moderated by estimates of GDP growth because that's fundamental into what's going in there. A likely global recession, so what happens to trade flows, import, exports, currency, depreciation of the rupee, etc. And then that COVID multiple is again further refined, whether in a current environment, the sector, industry, company is predominantly based outside a red, orange, green zone. And it differs for agriculture, okay? And we've been using that fairly consistently. We refine it very, very frequently. It's on the basis of new available information and data. And we think the ones that are best positioned at this point in time are the essential or steady state cyclical sectors. These could be things like pharma, fertilizers, city gas, and so on and so forth. Closely following, and these are the ones which are still doing well, and the recovery paths are shorter. Very close to them are the non-discretionary consumer goods and critical infra. And these would be, things like telecom, power, paper, chemicals. You could throw in agri products, and including sugar, which is big for India, and those sorts of sectors and companies. The ones which will take slightly longer into third quarter or something to recover this year, if things go as anticipated, are the industrial goods and services, which are cyclical sectors. And there the demand pickups will only be dependent on, the production pickup will only be dependent on demand and investment into infrastructure and other areas. And these will be things like steel, cement, and others. And I think finally, the longest time to recover will be the discretionary consumer goods. And these would be things, everything related to travel. So I'm not singling out just the airlines, or you even have the luggage companies in there, and you could have a lot of other manufacturing stuff in there. So things related with travel, gems and jewelry, auto, and so on and so forth. So the ones which are discretionary and can get pushed back will certainly face demand pickup, which is going to be far more distant from now.
Great, thanks for that, Rohit. Clearly a lot of work in the background on assessing the sectors. Ajay, I know you've taken over recently as CEO of CARE. So what have you seen, and what are your sort of clients and surveys telling you?
Yeah, so I think Rohit has summarized this quite well. I think our analysis is pretty similar to what has already been said. So I won't go into the details, but I'll just give you a broad sense of the sectors that we believe are likely to do well, which is, as has been said, agriculture we think is doing reasonably well. Rabi crop has been good. If monsoon is good, then we should have continued good productive food crop, and that is keeping the farm sector reasonably insulated. Also FMCG I think is likely to do all right. Pharma, as has already been said, is likely to do well. Banking and finance, obviously there is pressure. We are discussing lending appetite and all of that, considering banks fundamentally and NBFCs fundamentally run leveraged balance sheets. But from an NII perspective, we don't see that much of stress in the immediate, as the interest rates have been cut sharply, and the MCLRs are relatively stickier. So we believe there will be interest rate expansion or margin expansion for at least the large and medium set of borrowers, barring the asset quality issues, which we'll obviously discuss separately later. But we believe that overall BFSI will not be very hurt from a accrual and earnings point of view. In terms of slower sectors, we are all sure of the ones that are really going to struggle, which is aviation, travel, luxury consumption as well, and hospitality, restaurants, bars, all of that. The ones that are immediately, if I will now just spend a minute on what we as CARE Ratings have actually seen in the course of the last, let's say, from 1st of March to today, it's roughly 70 days. We have gone through as many as 164 downgrades, as opposed to only single-digit upgrades. So effectively, modified credit ratio, what the industry talks about, which is the ratio of upgrades to downgrades, has fallen from well above 1 to more like 0.78, which obviously reflects weakness in the economy, weakness in most sectors. So that, I think, is the summary from CARE Ratings standpoint.
Thanks, Ajay, for that. So it's interesting because I know the 2008 crisis, and even prior to that, rating agencies often took the can for slow action on rating downgrades or rating changes. There are upgrades as well. So I think this time around, there's a people are on the ball much more. Let me sort of ask a one-line answer from each of you, just keeping with the theme, the bond theme. Bond's boss, head of MI6, was called M. Just a coincidence. So if you, for your respective businesses, could ask M any one thing, what would that be? Jaspal, I'm going to start with you first on this.
Liquidity.
Okay. Rakesh?
Liquidity is sure, because I think that's key to our business. But I think in the current environment, extend the moratorium.
Okay. Manish?
Solvency support to customers, something similar to what they have done for MSMEs.
Great. Ajay?
Higher underwriting by government. Underwriting, not necessarily liquidity or funding, but underwriting.
Okay, thanks. And Rohit?
Look, very clearly, for me, it is going to be a miracle cure. That you know, we can ask for liquidity, we can ask for government support. I earnestly day and night pray that somebody discovers a miracle cure and we put it in operation as fast as we can.
Great, thanks. Thank you all. Interesting. So what came out of that earlier set of discussions was things are obviously bad. It is global. It's a question of demand disappearing from under our feet, global trade being affected, supply chains being impacted, and clearly from a risk appetite perspective, there's very, very little risk appetite. Yet there are sectors which will bounce back faster. And clearly, there, I guess, is a set of policy changes or policy requests which can still be made to government, and that's being done every day through your, through meetings. So that's great. Let me switch to specifically the sector now. NBFCs are a little different here because you provide credit, you also need credit. So you're sort of in the middle over here. The sector was clearly impacted with your first COVID, Jaspal, as you said, the ILFS situation. How do you see the sector bouncing back? And maybe Rakesh, I can start with you on this.
So I think if you look at NBFC and just prior to September 2018, if we see 1/3 of incremental, I think lending was being done by the NBFC. So NBFC was playing a huge role in terms of the overall economy, in terms of providing the working capital and the capital expenditure, which is needed from the business point of view, especially the MSMEs, the lower end of the customer segment. So they were playing a very, very important and critical role. What has got impacted is the liquidity, as Paul mentioned earlier. And this, I think more than liquidity is the risk aversion, because I want to give you an example of when the TLTRO1 was announced and there was 1 lakh crore of limit, and we had an oversubscription of 3 times because all the money went to the corporates, the best rated corporates, and another TLTRO 2.0 was announced and 50,000 rupees, 50,000 crores was announced for that. But the bid was out of 25,000 tranche 1, bid was only 50% of that. So it's more than liquidity, it's the risk aversion to a particular sector, which is and flowing the liquidity to the sectors which needs money. And I think that's the important and critical part. And also is the NBFC. Yes, as you mentioned, we need money to lend money, and that really is a big because it just not impacts the liquidity of one or NBFC sector as one, but it also spurs demand or impacts demand. So look at an auto, housing, real estate. So if NBFC slows down, I think all of this gets impacted. The MSME we just spoke about in terms of the impact, and they are the core of the economy. So it has to bounce back. I think the businesses have to really survive, sustain over a period of time, and we need to provide a helping hand. That helping hand can come from government, as a lot of us mentioned, in terms of underwriting, providing sovereign guarantees, the way SIDBI is providing credit guarantee. So hand holding for the next 6 to 9 months till the time the cash flow impact and the demand impact is there in the economy. So how do we really tide away this crisis? And as we all say, I think every crisis along with itself along with challenges brings opportunity. So I'm sure there will be opportunities, there will be new business models, there will be revival of the economy, and there the NBFCs which are better governed and which manage the asset quality well, I think they will be able to leverage and they will be able to do quite well once the economy starts picking up.
Great. Thanks, Rakesh. Jaspal, if you could add to that, please, what your views on?
Yes, so I, of course, agree with everything Rakesh said. And just to say that pre-ILFS, not only were NBFCs becoming a significant force in the Delta credit supply side, but actually, as of that date, as of September 18, NBFC was the only sector that had never defaulted with banks. We had individuals default, we had startups default, small businesses default, big businesses default by the merrymaking. But, you know, NBFC was one sector which had sort of preserved, and that's why they were getting a lot of flow. And how so much can change with one, not even a true NBFC failing, but I mean, that's a separate issue. So I think a lot has changed since then. I think the advantage that NBFCs have in a unique sort of way is that unlike banks, they cannot conserve liquidity because the negative cost of carry is too high. And secondly, because they don't get anything cheap in terms of financing in relative terms. And, you know, they need to, and because they're going to be far more focused on secured credit, the upper end of the sectors they were investing in, the niches they were in, the likely margin is also going to be narrow. So for that reason, I think there's going to be an imperative for them to lend. I think the last mile connectivity argument still holds true in favor of the NBFCs. And I think from a political point of view, I think the NBFCs provide to the middle and the lower end of the pyramid, starting from MFIs upwards, a very critical connect. So I think I have every reason to believe, just like was said earlier by Rakesh just now, but even earlier, that this will bounce back. The sector will bounce back. It's just going to be slow, but I think initially we will see more secured than unsecured, and people will be more focused on their niche strengths.
Great, thanks for that. So one key element which comes out is credit, liquidity to industry is clearly at a premium. It is scarce and we need to find it. In that context, the Reserve Bank of India has historically had directed lending, in the sense they impose certain guidelines on priority sector loans and so on, which is a fairly significant portion of the sort of total books, the total assets. So a quick sort of yes or no on whether this is still relevant today, and just a few points on if directed lending is indeed continuing, where is it best directed, which sectors? Manish, if you could give your views on that.
So, in my view, is it relevant? Yeah, yes, of course, because very clearly the potential in those segments, which in the normal course you end up ignoring, is definitely there. Yeah, it is underserved. Those sectors are reasonably underserved. I guess today technology helps you address or reach out to those sectors and look at figuring out your cost to serve, which otherwise is reasonably high, whether it is crop loans or looking to finance companies which are in specific agri sectors or to the weaker sections of the society. I guess today it gives you the ability to see how you can use technology, analytics, artificial intelligence, some of those tools to be in a position to reach out at a cost to serve which is relevant, and also manage your risks much better. So in my view, it is, and like I said, the potential is large because it is clearly underserved. It is not something which is easy for everyone to crack, and those who are in a position to, and people will find solutions, because they are, when you are pushed to the wall and you have to necessarily go out and lend in those segments, you will end up figuring out how you will get your act right. And more one is finding that like MSME lending in today's scenario, why is it that it is getting its flavor? It's because people are able to figure out how do you really uh, manage your costs of serving as well as manage your risks well in the sector. And my sense is that I think it is there to stay.
Okay. Um, anything to add to that, Rakesh?
So I think I completely agree with Manish. The financial inclusion, one of the big objective of PSL, priority sector lending, is to achieve financial inclusion. And we have to do so much for that segment, especially if India has to grow at much faster rates. I think the bottom of the pyramid has to be provided credit in terms of doing their business, building their own businesses and all. And to achieve that, whether it's the banks or the NBFCs or the MFIs, I think they have to provide credit to the bottom of the pyramid. And that's how you will be able to take the country as a whole in terms of on the growth path. Otherwise, I don't think we can achieve that.
All right. So it's here to stay and it is necessary. Thanks for that. Let me move to another question and maybe more economics in nature. There's a huge amount of liquidity world over. There's a huge amount of government paper being issued. Fiscal policy globally, including in India, has never been easier. So is there a risk of inflation? Will rates rise? Just a very short view. Manish?
I don't really see that in the near term. Till the time the demand really picks up, I don't see the risk of inflation or interest rates rising.
Jaspal, your view?
I think we have the perfect setting for inflation explosion. We have too much money floating around post the stimulus. We'll see that over the next few months. I think we have extremely low interest rates. And so as we just heard from Manish, that demand is the missing element of that equation. So yes, so I think we will probably have over the near term low inflation, but I think it will be a sudden shot when it happens because all the other fundamentals are right for it.
All right. Thank you for that. Let me switch to more sort of risk assessment criteria and so on. We've spoken a little bit about this, the current situation, the sectors which will bounce back, certain key aspects around what more can be done. From a risk perception perspective, we've had a series of governance issues in India, clearly whether it's NBFCs, whether it's corporates. So in that context, how do you see the risk assessment changing for your company, for your clients? Maybe Manish, if you can just, from bank perspective, walk us through that.
Yeah, so let me break it into two parts. From an immediate point of view, I guess the focus is to monitor sales of companies, capacity utilization, break-even levels, draw their cash flows in the near term, maybe for the next 3, 6, 12 months, and see how exactly people would cope up, what kind of losses companies may end up making in the next 3, 6, 12 months, how exactly are they looking at funding it. So those are some of the immediate risk assessment things that you would end up looking at. But more from a longer term perspective, I would say that the fundamentals of lower leverage, tighter covenants, lesser concentrated bets, and using analytics to see how can you really monitor your customers better early warning signals by use of technology and analytics. I guess that would be more focused from a longer term. Immediate term, I anyway shared with you. So
okay. And Rakesh, from your perspective, how is different from a bank? How do you see it?
No, so I think lending is, I think no rocket science. I think we have to just stick to our basics, do what is required from a lending as a commercial banking, which we say provide a working capital or provide capital expenditure investment in a business. And if you do basics, the moment people get into too many exotic kind of and too many products, and I think that's where the challenges and issues come in. So I think whatever Manish mentioned, do the cash flow analysis, everything else, but stick to the basics, try and see, look at the cash flow, cash is king, look at companies which are not highly leveraged, they are not expanding too fast. All of these things is what we need to really stay focused on and just stick to the basics and not do something exotic, especially in this environment.
Okay. All right. It's now rating agencies also rate NBFCs and banks. I'm going to ask Rohit and Ajay. Again, given what we've seen in ILFS, we had Yes Bank happen recently. How are you building governance into your rating criteria? Is there a 1-2 lines you can share on that? Rohit?
Yeah, sure. I think from a governance standpoint, it's fairly key and has always been in rating criteria. I think it's a question of, as regulation enables and as such incidents increasingly happen, the transparency will improve. And that enables you to monitor governance and other factors even more intensively. If you look at, for example, an Indian environment, 70% or 80% of activity is bank loans. Very little hits the capital markets in that sense. The capital markets display more transparency, like the equity markets do. And it's fairly easy to pick up early warning signals on listed companies. There's lots more disclosures on stock exchanges. Financials are made far more public, and material events are made more public. In more of the bank financing market is where a lot more transparency is also required, and sharing of information is required. So I think as regulation's been working very hard, the regulator's been working pretty hard to improve that transparency and information sharing and connectivity. And as that gets better, I think it'll just make it more safer for everybody, and people will be taking a more reasoned decision. But certainly a lot more needs to continue to happen to improve transparency and information sharing at this point in time between the lenders, from the lenders, with other market participants, auditors, audit committees, et cetera, et cetera.
Thank you. Ajay, anything to add to that?
Yeah, I think broadly agree with Rohit. Just a quick one from our care ratings perspective. First and foremost, rating criteria is really not likely to change, because that's what is the IP of a firm. It does not really change basis any event, but the rating criteria is basically the underlying principles on which ratings are done through the cycle, as opposed to them being done for short term, medium term. It's through the cycle rating processes that rating agencies follow, and so does CARE follow. But basis this event and basis the question that you asked, that last few years we have seen massive slippages in governance, and how do you basically prevent some of that? The processes have to obviously get more robust, and they are getting more robust, partly due to regulatory interventions, as cited by Rohit. SEBI is getting more active about this, is interacting more with rating agencies. Rating agencies have tightened their own processes a lot more. Reviews are far more frequent. More material event-related reviews are happening. Governance processes are being meticulously evaluated. Feedback from the market while doing an initial rating is being incorporated more actively. It is not just good to just talk to the bankers. It's also important to talk to supply chain. It's important to talk to vendors, local as well as international suppliers, and get more reputation checks done. Not just the filing of documentation on time by the company and so on and so forth, but more of that. And lastly, I wouldn't be complete in my response until I said this, that we also need access to CRILC. As rating agencies, we are supposed to be the guides to the investors and to bankers with regard to rating actions and ratings that we publish. It's important for us to have access to SMS 012 information. Otherwise, we only rely on bankers to furnish that information to us, is what Rohit also highlighted.
Thank you. So increased transparency all across.
Increased transparency.
And this, what's interesting in what you've just said, takes me back to the days I started banking in 87, 88, where we had consortium banking, where the RBI insisted all the banks had the same information. You had quarterly meetings, you had the same stock statements. So pretty much, what's interesting is these systems and procedures were in place. And, sort of getting back to that now in an electronic mode. Look, we're sort of, I had a few more questions. We've got a number of questions. We've got more than 100 questions which have come in from the audience. So I'm gonna switch mode right now. But before we do that, what we're gonna do is ask you a set of slightly different questions. You can call it rapid fire. You get coffee with or beer with native and executive access. You'll get a mug after this. That's a rapid fire. So let me quickly sort of, as the questions are sort of compiled by the organizers, let me start. Jaspal, let me start with you. Let me start with first, your favorite Bond movie.
Favorite Bond movie, Casino Royale,
Okay.
just for its sheer intensity.
All right. What is the funniest rumor you have heard about yourself?
I'm looking thin.
Okay. Post the lockdown, what would be the first thing that you would do besides work?
Take a walk on the seafront.
And if you could have used your time differently in the last few weeks, what would you have done?
I would have cluttered less and cleaned up more. I've just got paper all over the place, and yeah, it's looking more messy than it used to be.
And if you weren't a banker, what would you be?
At this point, anything but a banker.
All right, thanks, Jaspal, for that. So you get your beer mug, Aisha Agam. I hope you're listening. Ajay, moving to you. What is your favorite Bond movie?
I'd say Never Say Never Again. Great photography, great chase, and the standard spy action of Bond movies.
Excellent. And you're dressed like Bond today, so good. Household chores you have gotten really good at.
I've been the courier boy of the house. Every time there's something at the gate, I have to go down. So I've been a good valet, good courier boy in the last few weeks.
All right. And what are you reading now?
I like to be quite current on what's going on. It's a difficult situation for all of us. So I read a lot of global and local macro. No fiction at the moment. I've just taken on a new job, so just focused on getting my hands a little more comfortable about this new job.
All right. And one advice to your people to stay relevant in these times?
I think it's. I've been saying this to my colleagues as well. I think it's exceedingly important to stay to stay very well informed. Things change very, very fast, and it's not not okay to just review on a monthly or quarterly basis. Literally every single day is a new day, and it's very important to stay exceedingly well informed in these markets.
Great. And if your kids were to become bankers, what would you tell them?
Oh, it's a tough one. My kid is not on the way to be a banker for sure. But if they were to become bankers, I would say go back to old principles. Forget the jazz, as one of the other speakers said. Just focus on principles. Just focus on basics. Don't have to get into fancy stuff.
Okay. Thanks, Ajay. Thanks for that. Rakesh, over to your favorite Bond movie.
Skyfall. Daniel Craig's sharp suits and all which he wore in that movie.
Excellent. All right.
Yeah.
And from your perspective, one person's shoes you would not want to be in today.
I don't know. Maybe the Prime Minister of the country in such a difficult situation.
Okay. All right. And if you could have used your time differently during this last few weeks, what would you have done?
So I would have done reduce the number of Zoom calls and Teams. I think there's too much of it from 9 in the morning till 8 in the evening. So I think I would have reduced it. So for sure, because there's no action on the ground, all the action is happening on the Zoom and the Teams.
All right. So Zoom till 9 and Netflix after that.
Yes.
The household chores you've really gotten good at?
So cooking once in a while, just cooking dinner once in a while.
Excellent. By the way, Rakesh and I are neighbors. So Rakesh, I'll sample your cooking sometime.
Sure, sure.
All right. So post the lockdown, what would be the first thing you would do besides work?
Go to my barber, get a good haircut. I've been struggling for the last now 2 months.
All right. Thank you, Rakesh. Thanks. You've earned your beer mug.
Yeah.
Rohit, over to you. Your favorite Bond movie?
Casino Royale. I'll go with Jaspal's choice. It's always been my favorite. I watched all of them, but this one clearly sticks with me. Life's a gamble.
Okay. And what is the funniest rumor you heard about yourself?
I hear a lot of them, a lot of times. It's best avoided.
Okay. And what do you miss most during the lockdown?
I think the one thing I miss most is not being able to be there for my parents at their age and without any help. They're in a different city, and that really drives me to desperation. As they need me more and more every single day, I'm not able to do anything for them from here.
Okay. And one web series you would recommend people watch?
Well, there are loads, but I have gone back to rewatch Narcos. I thoroughly enjoy watching them. So I'd recommend Narcos.
All right. And next year, same time, what do you hope to be doing?
Next year, same time, I hope to be at least some sense of normalcy and getting back to doing the things that I enjoy most. I was planning to start to learn the saxophone all my life. Maybe by next year, I would have learned it.
All right. Good. Jazz and a good dinner which Rakesh cooks up. Excellent. Manish.
Well, I guess it was Skyfall, what Rakesh also mentioned. Daniel Craig is, in my view, the best.
Okay. And what chores have you got? Household chores have you got good at?
Gosh, my wife is listening right behind. The truth is, I haven't done much.
Okay. And what is the best advice then you have received? It can be from your wife as well.
No, so I guess be on the edge, stay alert, both for risks as well as opportunities.
All right. And one person's shoes you would not want to be in today?
Airline CEO.
All right. No flying. And one thing you miss most during the lockdown?
Meeting customers, meeting people.
All right. Great. Thank you for that. Thank you for that. So thanks guys. That was good. Good to see this aspect of your personalities in your lives. I'm going to switch to some questions now. So we have a question. I'm going to read it out as it's been received from Biswajit Sengupta. With the developed markets worldwide having negative or close to zero rates, do you think a foreign currency India bond makes sense as an alternative source of funding to invest in infrastructure? This would also not crowd out the Indian bond market. So I'm going to ask that question. Ajay, do you want to, should we do a sovereign bond issue?
I think the debate on this has been on for a while, and I think this may be in many ways a good time to continue with that effort. The only thing is that at this moment of time, with almost all sovereigns under pressure, and I'm sure that with slowdown impacting everybody on a relative basis, every country will be evaluated by rating agencies as well. So given the extent of the damage caused by COVID-19, India may not want to create a benchmark that starts to measure India's sort of mark-to-market, and all the pressures of a bond issuance in the open market could be somewhat challenging in times like this. Is this the right thing to go over a period of time? Yes. Is the timing right immediately? Probably not.
All right. Okay. So keep it in consideration, but figure out when.
Yes.
All right. I'm going to go to the next question. This is received from Amit Gainda. the NBFCs play a pivotal role in providing last mile credit and enable credit growth. Broadly speaking, the NBFC play begins where the banks end. What would you therefore recommend as one key sectoral support or reform by the government for NBFCs, which will instill confidence in them to lend again? Jaspal, I'm going to ask you this.
I think the guarantee scheme that the government has already announced, MSME, if it is well implemented, I think that is already a big start point. So I would say we can just stay and go with that.
Okay. All right. Thanks. We've got another question from Rahul Buskute. Wholesale lending had largely been absent since 2014 after the start of the AQR process by Raghuram Rajan. Mutual funds and NBFCs had picked up some of the slack in the higher and lower rated borrowers respectively. Even these lending engines have shuddered to a halt. When do the panelists think the wholesale lending will restart, and who would possibly be leaders starting this, the bank leaders? So Manish, let me pass this to you.
So in my view, credit growth 12 to 18 months is how I would see it, and very clearly linked directly to how the consumption demand picks up all over again. And my view is 12 to 15 months definitely for a vaccine to come to give people the comfort for normalcy to return. And in my view, this would be the stronger, the players who emerge stronger will get to see more opportunities in terms of capturing this growth when it comes. And it could be government banks, it could be strong NBFCs, it could be strong private sector banks across
the board. Okay. I'll move to the next question. This is from Rajagopal, A. Rajagopal. This question is specifically for Rakesh and Jaspal. It's mentioned there. How are you looking at ALM? Clearly, fresh liabilities are going to be a challenge for most NBFCs, and at the same time, assets may not be getting recycled. Let me start with you, Rakesh, for this.
So how we are looking at it? We are looking at it very closely on a daily basis. We have been looking at ALM not only in this crisis, but post-September IL&FS crisis. I think most of the NBFCs sorted out their ALM issues post-September 18. So in that way, NBFCs were much better prepared. In terms of liquidity, which we spoke earlier also, I think there's some risk aversion which is there in the lending institutions or in terms of buying the paper of NBFCs. And I think that's where we need some well-directed funding to come to NBFCs, especially at the lower end of the NBFCs, which lend to the MFIs and they lend to smaller NBFCs. I think they're the to come. But clearly, ALM is on our top priority, and we track it on a regular basis.
Thanks, Rakesh. And Jaspal, to add to that, ALM?
No, I agree with everything that is said. I would only add that co-lending is more likely to get more in practice than it was before.
Okay, co-lending is a model. Good. Another specific question which has come in, it says, hi Rakesh. MSME contributing 30% of GDP is clearly a key for the country's revival. What are your views on on-the-ground execution of the guarantee scheme for MSMEs?
So if you look at, and I think Jaspal also alluded to this, I think providing guarantee to the lower end of the self-employed businessmen and micro businesses, I think it's key. Even if you look at this worldwide in 2008 and 9, and the way Singapore brought in the credit guarantee to support the lower end of, and globally it has been used. So it's, I think, very strong and potent tool if it's used effectively, and this reaches the MSMEs. They get the incremental credit because of this, because if there is a risk aversion with NBFCs or micro, and they can really lend through this credit guarantee, I think that will be, because then the cash flow and liquidity comes in the hands of the MSMEs. So very, very important that it's effectively reaches the MSMEs.
All right. So it has to reach. Great.
Yeah.
Thanks. I'm going to ask this. There's a question on, we've seen a few round of mergers in the financial services space. Does the current scenario look ripe for a few more? Rohit, I'm going to ask this of you from where you sit.
Look, I think yes. If you're looking world over, there is enough liquidity. If you're looking at private equity players, global private equity players, they're sitting in the US as well. One estimate was $3 trillion of money to invest. And I think as soon as the market starts to slightly stabilize, you will start seeing some play in the consolidation. There will inevitably be consolidation. Even before the COVID crisis, people were talking of consolidation, further consolidation in the financial services industry, and that will happen.
Okay, so you see that happening. All right. I deliberately didn't ask any of the bank or NBFCs for that. Didn't. Okay. Now, another question: is a bad bank a good idea? Ajay, I'm going to ask you this. Just a quick snapshot.
Well, candidly speaking, it's a good idea. But it requires a significant amount of capital infusion by the sponsor, which is likely to be Government of India. Because the size of gross NPAs in the system pre-COVID were more like 10 lakh crores. Even if you took a net NPA number of 5 lakh crores, PCR ratios of 50-60%, maybe 4 lakh crores, the size of the bad bank is quite large, and 10,000 crore is what the speculative number has been of equity injection by GOI towards this initiative. I would suspect that the bank has to be capitalized exceedingly well, because the ability of this entity to be able to raise leverage is not going to be great. Or else the other way could be to actually have a number of global distress funds participate in this and give them a significant sort of upside as assets resolve, to be able to bring in the capital. As we all know, distressed funds operate at 22 to 25% ROE. And unless and that's because of the inherent risk of the business. So one, capitalization should be larger. Second, it has to be a size play, and therefore the participation of risk needs to be sold to global investors substantially.
Great, thanks Ajay for that. Look, we have over 150 questions on the screen now, and I do apologize we don't have time to get to all of them. But look, I just want to stop here and say a big thank you to all the panelists. It's been a very engaging discussion, very useful insights, both about the sector, what you see happening, what is needed. And there is positivity. There are sectors which will revive. There are actions being taken to prepare for the sort of upturn as one sort of sees it. So I just want to thank each and every one of you for a very engaging session. I'm going to stop here and hand back to Shubh.
Thank you, Ananth.
Hi, guys.
Really great. Thank you so much.
Thank you.
Yes, Yatri, over to you.
Ananth, well,
Yes.
that was indeed an insightful session, giving us a lot of clarity and direction on how the credit ecosystem could revive post the lockdown. We've almost had over 1,000 people logged in today. Thank you, Ajay, Jaspal, Manish, Rakesh, and Rohit for sharing your perspective with us today, and Ananth for being a wonderful moderator. To our attendees, we appreciate the time you've taken out of your busy schedules to be here today, and we hope you've enjoyed the session as much as we did hosting it. The recordings of the webinar have been posted on the website by the weekend. We look forward to hosting many more such webinars. In fact, there's one interesting one coming up on this Friday with panelists from few of the largest private equity funds, and they'll be sharing their insights on deal making. You do not want to miss this, so please stay tuned. Have a wonderful evening and stay safe, guys.
Thank you. Thank you, everyone.
Thank you so much,
guys.
Thank you, Ananth. Thank you,
Thank you.
Native, and thank you, Executive Access.
Thank you.